Ladies and gentlemen, welcome again to the 11th session of Wealth Management for Working Professionals. In the last session, we have discussed about the behavioral finance. That is the last session. That is the third session of behavioral finance. So let us recap what we have learned in the last session and before we start going into the new session. So so we started with familiarity bias. Familiarity bias is a kind of a bias which we all have, being familiar with what we know or what we are familiar with. So even in the investments also, we tend to invest into certain areas where we are very comfortable or very familiar with, and that is the reason why we tend to crowd all our investments in that particular area or segment within the so-called circle of competency. So it is found as per the research conducted in US stock markets. It's found that around, those people who are with this particular bias, so they don't perform better than the so-called market benchmark, which is in that case, it is S&P 500. So by a very fairly wide margin, 8.19 percentage. So the actual performance of S&P happened to be 13.69 versus what these people have performed is 5.50 percentage. Probably maybe a bit better compared to uh, what a risk-free interest gives. But yes, when it comes to Indian parlance or in Indian specific case study, so we in India it is 7.1 percentage, which is said to be the risk-free interest rate. So this performance is not very highly underperformed. So similarly, it was also found out in 2020 as a follow-up to the same publication. Delbar again, he concluded that even those investors who tend to invest into debt also, they also don't perform better than the benchmark, which is 8.72 percentage, because of this particular familiarity bias. So next is another biases which we have is fear of regret. In fear of regret, generally when we took a wrong decision, when we come to know, so we don't want to feel regretted by taking a wrong decision by selling it, knowing very well we have committed a mistake. So people tend to stick on to what they have, uh, committed or invested into. So due to this, a lot of money is lost. So this is one more bias which we are into it. Then there is another prospect theory and loss aversion. So it actually this theory suggests that people express different degree of emotion towards gains and losses. So individuals which tend to overreact or display more anxiety or negativity towards the bad news compared to the good news. So this theory explains why we tend to, take bad news quite seriously compared to the bigger good news. So this is the theory at work. Then there is anchoring behavior. It is like, we got fixated to latest information or news or certain viewpoints. We don't want to be flexible and move ahead with whatever the market offers opportunity. So this anchoring behavior is also responsible why we fail to react to or respond to the markets and market behavior, whatever, however market throws the opportunity. So only the smart few people tend to take those opportunity and get benefited out of it. Usually, most people, because of this anchoring behavior, they tend to miss the opportunity. And as we have already discussed, it's all about under or overreacting. So both are very bad. Overreaction is generally we tend to overreact to negative and then immediately take certain decisions which are irrational, especially whenever there is a downturn, whenever there is a crash in the market, we all tend to sell it, assuming that it may fall even further. And underreacting is when things are going pretty bad, we tend to react so slow and late and keep on waiting. That is also, these two are extreme cases. So we just need to avoid. We have to take appropriate action or react appropriately as per the situation it demands. So the another one is very important is overconfidence. This is one of the biases which we all have, we all suffer from, and due to this overconfidence bias, we tend to overassess our abilities, though it may not be up to the mark, and overestimate our knowledge, our timing, even the precision, and we feel we are superior to others when it vis-a-vis others, and then we commit a mistake, and in the long run, we book a lot of losses. So we should best avoid overconfidence. Then there are social factors which are at play, as I have discussed in the first session itself, how socio-cultural religious factors uh, have an effect on our cognitive abilities vis-a-vis the rational decisions we need to take. So they tend to, because we are being socially conditioned in such a way that we tend to first think that and later into other aspects of life, and that keeps on interfering with your uh, whatever the rationality or the right kind of decisions. And many a times this socio-economic and cultural factors or religious factors, they have such a negative effect that it will go against the principles of rationality, logic, and reasoning. So in the process, you tend to lose money. So is this a norm or is this a kind of anomaly? Actually, many a times, there were so many research which is conducted. It is found that most often people behave irrationally, unlike what is being the usual standard hypothesis in the entire realm of finance and economics, which always state that humans are rational and they tend to take rational decisions, and efficient market hypothesis, which is propounded by Eugene Fama and Ken French. Their theory also propounds that people are, take rational decisions, and it is how the market discovers the right kind of a price. But however, they also say that whatever the anomalies are, they are all short term, and in the long run, it will get disappeared and market return back to efficiency. This is a theory. However, it may not be true because our body releases catecholamines, which are like chemicals which affect you when you are in stress. So you tend to have a bad behavior. Finally, that interferes with your cognitive abilities and your decision making capabilities. So you may not take the optimum decisions. The decision making is suboptimal, and finally you suffer. So why do economic actors behave irrationally? It's a very complicated thing because mind, psychology is so complicated. So many factors are at play, and most important, mostly is really, which is being identified as one of the major reason is, limitations in the human mind's ability to identify and process information. We all have a certain ability to process information. Information processing is dependent on the level of education we have, the intelligence we have, and the kind of, you may be intelligent, you may have a better education, but if you are not trained or familiar with that particular area, we tend to not process the information properly. Apart from that, language, cultural factors, socio-economic, and then experience, all these things play a major role in determining your rationality. And psychology also attributed a role of human emotions and subjective biases, which we have already discussed while making decisions. These are the factors which play a major role in why we tend to behave irrationally. What does this mean to the investors? Yes, it is always better to know about all the irrationalities and the factors and the reasons behind such kind of irrationalities. then we will be in a better position to avoid such kind of behavior coming into, interfering with our day-to-day life or even decision-making capabilities, and that will make you a better investor. So then we have shifted to focus investing. Focus investing is based on what Warren Buffett, propounded or and practiced it, and which most of the top investors they keep on focusing on that. In focus investing, they they put psychology and behavioral part into investing, and then they put much more faith on own research rather than luck, and they are not swept over by the short term events. Basically, and also they have very clear cut goals and what they should do and what are their goals in the long run, and also they take into effect the risk, and those people who are in focus investing, they should accept all the consequences with confidence. And then you know whenever a particular person or group of individuals make an error in judgment, and that will affect our career, so we should avoid taking somebody else judgment. Rather, we have to pursue what we feel is right, and you should believe in your own abilities rather than somebody else's ability. And then there are, if suppose thousands or millions of people, especially investors, make an error in judgment, so that error in judgment will be reflected in market. Market will push it to a destructive direction, whereby because of the crowding effect and because of the herd mindset, it even compounds this bad decision, and finally it will have a very negative impact on the entire wealth of investors. So mostly we need to understand most of the people are irrational because they don't know how to control their emotions. They are not patient, they are not calm, and they are not rational. So unless you have this temperament, you can't make yourself into a right kind of investor. So stock market, by in any means, it is, there are constant fluctuations. These fluctuations should not affect you or your emotions. You have to keep your emotions under control and believe and trust in the logic or in the decision you have taken, and continue with it. So this is what focus investing all about. And then coming to what are the final takeaways, which we have discussed on that yesterday, sorry, in the previous sessions. It is like, what you have to do, if you have to be very successful, you have to have courage over your own convictions and do your own thinking and research. And what are the steps? There are four steps which you all need to do. First, step number one: turn off markets, especially stock market is a depressive maniac. So that will keep you become the so don't become a victim of stock market. Don't become depressive maniac. And then number two is don't worry about the economy. As we have discussed, there is no direct correlation between the market performance and economy. And step number three, buy a business, not a stock. And step number four, manage your portfolio of the businesses, which we will discuss at the later stage. Then, what are the final takeaways? This is what Warren Buffett have proposed. So, investing is not complicated. You need to know accounting, the language of business. So, we all need to understand that investment is simply putting money in pursuit of appreciation in your wealth. Wealth management, wealth can come either in two forms, either in capital appreciation or in getting, returns in terms of profit. Profit can be in terms of dividend income or some other in the form of what company gives you back, and then or even free the so-called bonus shares or splits, whatever. So these all things are something which gives you, which increases the wealth, appreciates the wealth which you are into. So the second thing is you should read Intelligent Investor. This is what Warren Buffett say. But what I suggest you is apart from Intelligent Investor, there are few more good books like The Warren Buffett Way by Robert Hartgron, and then there are few good books written by Saurabh Mukherjee. He wrote it in a very simple, usage way, so that every investor can understand what he has written. It's very excellent. Three books I can suggest of him is number one is uh, Diamonds in the Dust. It teaches you how to pick up the diamonds in the dust, certain very simple formulas where everybody with the average intelligence or a little bit of understanding about stocks, companies, they can easily pick it up. The second important book is Coffee Can Portfolio. It's a very interesting philosophy, like it is propounded by Robert Kirby. Kirby happened to be one of the wealth managers. So one of his client who happened to be, who had forgotten where he has invested, what is that? All of a sudden he has seen. To his surprise, without any kind of interventions or making any active changes in his portfolio, he left it as it is. So to his surprise, it was found that his portfolio has outperformed even that of Robert Kirby, and that led him to do further research into what were the reasons. So it's very interesting. Coffee can portfolio means coffee can is in the wild west migration of United States of America. So especially during 19th century, so people used to put their dollars or money into the coffee can. So and whenever they were in need, after say a lot of time, they used to remove that and then they used to spend it. So with that same philosophy, this particular coffee can portfolio is given, whereby you have invested into some stocks or some bonds. You left it for a very long time without even touching it. So that led to stupendous increase in wealth. And Saurabh Mukherjee has shown that these coffee can portfolios for 10 years have consistently beat the market returns quite handsomely. And in some cases, they gave 32 percentage compounded interest. However, on an average, it is around 20 percentage. So 20 percentage per se is a huge amount of appreciation. So this is second book, and book number three is Unusual Billionaires. He made a study of some companies, and he tried to understand what are the economic moats they have generated, and he used IBAS framework to explain how these companies have performed. And it's a very excellent book, which you come to know why some companies like Asian Paints, then your Divi's Laboratories or About India, all these companies, why they are successful, how did they build the moats, and what are those moats? So it's a very interesting kind of books. So next is you need to have a right mindset and right temperament, which I have said. Right mindset means you have to be open-minded. You should not be bound by your socio-cultural or even religious whatever principles or ideologies in your rational decision making. So you have to be open in your mind. You should not have fixed ideas. Rather, you should be flexible as per the market demands or commands. So, and then the kind of temperaments you need to show is you have to be calm, patient, and rational. And rationality means you have to take decision making based on the information available, and doing the right kind of research and understanding the concepts with quite clarity. And you have to have a very clear mind. Then you should be interested in the process, how wealth is generated. You need to understand business as a whole rather than thinking that stock market or selling or buying of shares is just sale of one paper consisting of your so-called dematerialized share certificate. It's not that. It's basically you are investing into a business, so accordingly you have to apply all kind of due diligence and be in your circle of competence. By circle of competence, it means that you need to know what are the areas which you are familiar with and best with, and accordingly it will be easier for you to understand the business, because it's very difficult. There are so many sectors and areas, many of the things are unfamiliar with you, and the kind of oversimplification is quite tricky, and finally you may land up losing money. So then you have to read Benjamin Graham and Philip Fisher, and then read annual reports and trade reports, but don't do any equations in Greek letters in them. This is what is being said by Warren Buffett in 1993 when he is addressing his shareholders. So I think you need to take these advices very seriously. Then some of the quotes what Warren Buffett have said, I think they are quite interesting. The basic idea of investing are to look at stocks as businesses, use market fluctuations to your advantage, and seek a margin of safety. That's what Ben Graham taught us. 100 years from now, they still be the cornerstones of investing. And Ben Graham, in his book Intelligent Investor, he propounded certain basic ideas about investing, and that wealth of knowledge he has acquired based on his experience as a investment broker or advisor, and then later he himself invested into stocks, and then he happened to be a victim of so-called Great Depression. So Great Depression has taught most of these so-called investment gurus. So that's how they put their practice and experience into theory, and finally they came up with what the basic proposition which is said is, you have to always look at stocks as business and use any kind of fluctuation to your advantage. When it is on a low, when it is a bear run, you better buy shares, and then when it is a bull run, you sell the shares. And that is how you need to take. And whenever you are purchasing, you have to purchase at a discount with a margin of safety. Margin of safety is being explained in last few sessions. So this is one of the most important thing. Like you define what will be your margin of safety. See, even in the worst scenario, many companies' intrinsic value, if it fell down by say 50 percentage and below, is said to be most safest bet, and you can immediately jolly well put your money into such kind of investments that give you good amount of decent yeah, sort of decent returns. So that's what Benjamin Graham taught all of us, and it will be there for very long time to come. This will be the basic, or you can say the principle which any investor has to apply. And by far better to buy wonderful company at a fair price than a fair company at a wonderful price. So if given a choice between two companies, like an excellent company and a mediocre company, or an average company getting at a very cheap discounted price, so compared to them, you can better opt for a wonderful company even at a fair price. So this is one. And in one interview given to PBS Money World in 1993, Warren Buffett was asked what would be the investment advice he would give to money managers. Then he said that, I would tell them to do exactly what I did 40 years ago, which is to learn every company in United States of America that is publicly traded. So the moderator Smith said, protested and said, there are around 27,000 public companies. Then Buffett said, okay, you start with Ace. So that means there is no other way other than to understanding, reading, whatever, knowing about all the companies which are being traded. Only then, with with 100% precision or at least 99% confidence levels, you can say what is good, what is bad. So it will be a tough job, but yes, there is no shortcuts for any success. To be successful, you need to do. And it's a matter of wealth. If you are interested to accumulate more wealth or improve your own fortunes, naturally you have to. And all we want to be in business that we understand, run by people whom we like, and the price attractively related to their future prospects. This is one more very interesting quote. Then what he says is, be into a business which you understand, and also run by those people, by those managers who are highly professional, qualitative, and they are known to for for their excellent work, and then whom we like, or we basically make them as our role models. So and then you have to see those such companies are relatively attractive and having a better future prospects. And then next quote is, I buy businesses, not stocks. Businesses I would be willing to own forever. This is an extension to what we have discussed. And another quote is, I want to be in business so good, even a dummy can make money. So uh, this is a quote which is like, you go into an excellent company where irrespective of whosoever is the manager, the company will perform better. Like there are quite a few companies of that nature, which those companies are the companies which have sustained competitive advantage, or the businesses are there for very, very long time to come. So next is look for durability of franchise. The most important thing to me is figuring out how big a moat is around the business. What I love, of course, is a big castle and a big moat with piranhas and crocodiles. So this is a very interesting quote, again related to whatever we are discussing. So you always, since the only way you can make money is to be in the long-term perspective. Long term here means, does not mean it's only 1 year. Long term here means around 10 years. Anything above 5 years, 10 and above is the horizon which you need to look at. And when the horizon is very long, all the fluctuations get eased out and you get a perfect, smooth curve, which is upward moving, provided you identify a company which has sustainable long run and have a very favorable business economics. So and such kind of companies also, you need to understand, those should be the companies which have built a big moat is nothing but a sustained competitive advantage where others cannot enter or compete with such kind of companies. It's not that all the time people can construct moats. For constructing moat, a company has to be very, very nimble footed. Number two, they have to have excellent R&D team, an excellent sales team, and they should have global footprint, and also they should continuously engage with the customers. They have to engage in changing technology, changing workplace, and the changing so customer choices and tastes. So you have to keep adapting to changing circumstances and situations. That is how you can build a big castle and big moat with piranhas and crocodiles, so that nobody can enter into such kind of castle. So when you have able managers of high character running businesses about which they are passionate, you can have a dozen or more reporting to you, and still you can have an afternoon nap. That means if you put your money into highly capable managers and who are very passionate about their own businesses or what they are doing, naturally, you can hire so many people, and yet you can have a nice sleep. So next quote. is in evaluating people, you look for three qualities. Number one quality is integrity. Number two quality is intelligence. Number three is energy. If you don't have the first, the other two will kill you. So be mindful. This is not only useful in, in your, this is very useful in identifying right kind of people for right kind of job. So I read annual reports of the company I'm looking at, and I read annual reports of the competitors. That is the main source material. This is the crux of everything. See, if you want to know about a company, it's not just reading about the company. You have to read about their competitors. Their competitors, when you compare the competitors with that particular company, that is where you can understand what is doing well and what doesn't do well. What are their, SWOT. You can make a SWOT analysis. Finally, you can identify the winners from losers. So this is how you come to know about so many things. Then next is it's bad to go to bed at night thinking about the price of stock. We think about value and company results. The stock market is just to serve you, not to instruct. So it's a very, very important quote. You just be least bothered about the stock prices or what the stock market, performance is. So you should more bother about what is the value you have calculated about a company and the kind of a result it is generating. So to properly value a business, you should ideally take all flows of money that will be distributed between now and the judgment day and discount them at an appropriate discount rate. That's the what value business is all about. Part of the equation is how confident you are at those cash flows occurring. Since some companies are easier to predict than others, we try to look at business that are predictable. So this is the most important quote of Warren Buffett. Many people, they are good at other analysis, but very very bad at identifying a value of a particular company. So what do he mean by this particular equation, which I have discussed in 4 or 5 sessions, whereby splitting that equation of that value in three scenarios. Scenario one, when it is normal growth scenario. Second is growth scenario, and then the third is when the growth is much higher than risk-free interest rate. So we have split that into two equations. Equation number one is related to the cash flows for 10 years and then finding a terminal value at the end of 10th year based on a constant growth. So that is how need to evaluate. That is what he was saying. Like ideally, you have to identify what should be the cash flow of each company and how much will it generate, and you have an appropriate discounting factor. Discount rate usually is risk-free interest rate, and second is it all depends on how confident you are about the cash flows, and finding out appropriate cash flow itself is a very big challenge that needs a lot of understanding about the business, lot of a lot of research. Research is also needed. You have to go through so much of material, especially their annual statements and annual reports. So they give you a canon feed. So, and then some businesses are easier to predict while others are highly unpredictable because of the nature of the business. Like, cyclicals are cyclical in nature, whereas, technology is highly difficult to predict. We don't know, one time you may perform very well, the next time you may have kind of a competitor who has broken the secret, and then the other is like many a times the technology keeps changing, and if you fail to change according to changing technologies, naturally you're totally gone. So this is it. And in general, what Warren Buffett looks at is the predictability of the business, not the unpredictability part. So then great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause stock to be mispriced. So this is a great opportunity. You need to identify opportunities when companies, excellent companies, are unusually, in a bad state. So that is the time when you need to invest. So when when Express, there was a, as we discussed in 1960s, when American Express, when they used to have those cards, they were affected by a scandal. So that because of that scandal, that value of that share declined by around 50%. And when he was coming from his home to office, he found that people are still, going and using American Express, at least bothered about whatever the scandal or scam that has happened. So immediately he understood that when people are not, or any scam or any negative news, don't have a dent on a particular company's reputation and image or brand, that means that company will do well irrespective of kind of negative news which is in the market. So immediately he put all his money into American markets. That's where he made huge amount of money. So you all need to take such kind of opportunities in the right perspective and invest, and then you be successful. Success is in investing doesn't correlate with your IQ, and once your level is about 125, once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. So it's not about your intelligence. Per se, it is about how much control you have, how much you can control compared to others. So have always, have a control over your emotions and be more disciplined. Don't get into trouble because of your bad temper. And we don't have to be smarter than the rest. We just have to be disciplined, more disciplined than the rest. So this is very, very important. And I came to psychology of misjudgment almost against my will, and I rejected it until I realized my attitude was costing me a lot of money. Very, very important quote. So we tend to reject most of the opportunities because of the misjudgments and because of our attitudes. And if we have a negative attitude is contagious. It will spread and naturally it will kill you. Rather, you just ensure that your attitude don't burn a big hole on your, portfolio. And whatever maybe with your, you know, uh, your relationship with others. However, when it comes to money, you have to be very, very, very even tempered, or you should have a good temperament. Have more patience, be calm, and be rational. Always and any time. Stocks are simple. All you do is buy shares in a great business for less than the business is intrinsically worth. Management of the highest integrity and ability, then you own those shares forever. See, simply speaking, he was asked what kind of business you would be invested into. So he says that, I would, the time period for an outstanding business with excellent management, with high integrity and ability is forever. So any good company is there, then you have to hold them forever. That will reap a better benefit than putting money into mediocre companies, waiting for a high appreciation. So the churnout will be very high. As we have discussed in the past, the more transactions you make, the more tax you are going to pay. And finally, you end up losing a lot of your, wealth. So don't do that. So market is the only is there only as a reference point to see if anybody is offering to do anything foolish. So you take market only as a reference point, and with this quote, it means that you just have to see whenever something, some drastic decline or a decrease in the prices are going to happen. That happens, you have to go and take it to your advantage. Investing is not complicated. You need to know the accounting, the language of the business. I think this I have already discussed. You should read investor. This is we have already covered. So finally, is it too late to be like Warren Buffett? Actually, the answer to this is there is no such thing as being too late to be successful as a person. Warren Buffett did he revealed what makes him more successful. So I think this series of Warren Buffett is has come to an end. So you just follow all the principles which we have discussed till now. So this is one of the best kind of series which you can understand. And for all the investors, there is nobody better than Warren Buffett, and you can take him as a kind of an inspiration, as a guide, and that is how you have to learn a lot from him and be a successful investor. Be so, follow his 12 principles which we have discussed. To reiterate, I'll just once again I'll quote it. So what is that? Those 12 principles which you have to diligently follow to be very successful. Those are, there are 12 principles as such. So I'm just going to say it. Number one is, yeah, there are, four principal tenets or, areas where such principles are applicable. One is the business tenets, second is management, third is financial, and fourth is value. In business tenets, first and foremost is the business simple and understandable? And second one is, does the business have consistent operating history? The third principle is, does the business have favorable long-term prospects? Fourth is the management rational? Fifth is management candid with its shareholders? Candid here means uh, free and frank. And then, does management resist institutional imperative? Institutional imperative means some foolish, behavior because of, or provocation to do something foolish. Then financial tenets are, what is the return on equity? When it comes to Indian stocks, it is return on capital employed, ROCE. And then a return on equity, we can use it for banking, finance, and insurance sector. So, what are the company's owners' earnings? Owners' earning, we mean whatever the surpluses left out after taking care of all the liabilities, like staff payments to the creditors, to the vendors, to the government, and so on. So finally, whatever is left, that is called as owner's earnings. So that earning is a very crucial part. It can be used either to pay dividend or to reinvest back into the company. Then what are the profit margins? How they are faring vis-a-vis the industry average? The principles of investment teaches us to go for those companies which are uh, above average in terms of rate of returns or return over equity or profit margins, or even how much of earnings they generate. And then the 10th is, has the company created at least $1 market value for every dollar ten? It means whatever the money reinvested into the business, is it generating more than what is being invested or not? If it generates more, it means it is profit making. It is generating less, means it's sustaining losses. And value tenets, there are two tenets. What is the value of the company, which we have discussed a lot, at least in 3 to 4 sessions. I have given how we have to calculate with the help of Excel sheet.
And can it be purchased at a significant discount to its value? Of course, this is one of the very important in it. So follow these for 12 principles. Along with that, understand whatever the behavioral part which we have discussed, especially while taking into consideration our decision making. So psychology of markets, and then we have discussed about irrationalities which we are subjected to, like overconfidence, being overreactive, then loss aversion, mental accounting, risk tolerance, herd behavior, emotional gap, anchoring, self attribution, confirmation bias, experiential biases, loss of familiarity bias, then your fear of regret, prospective theory or loss aversion, then anchoring and over and under reacting, investor overconfidence, social factors. All these factors you need to take into consideration and then follow the four principles which is being said. Step one, turn off the markets. Don't, be with that particular, you take only stock market as just an indicator, not something which you need to diligently follow, right? Turn off the markets, otherwise it's highly depressive and maniac. So you are also your stress levels, anxiety levels, as well as mental health will be very much compromised if you tend not to do it. Then next is don't never worry about economy. Never try to time your entry into the market depending on the news about how the economy is going to perform. Things are not going to be that way. There is no correlation as we have seen, and I have shown you in terms of a graph and based on a study that why there is no correlation between both. And then next step is buy businesses not as a stock but as a business. And fourth is manage your portfolio. These are the principles you need to follow diligently. Then definitely you can be very, very successful as an investor. Thank you all for this session. So we will start next session, which is session number 12, with other principles. Like till now we have learned the theory. Now we will go into some amount of practice part, and then how the markets responds, and then we will continue with the so-called you know pearls of wisdom also, so that that will give you a practical insight into what the markets are and how you have to learn from the great investors like Charlie Munger, Warren Buffett, Junjunwala. All these quotes are from people like them. So those quotes are wise quotes. I have put it. I have collected a lot of quotes which are I felt to be highly relevant for all of you to understand, so that there you can follow it diligently, understand it, and take to your advantage. Happy investing. Thank you, guys. Thanks for this opportunity.